This is the presentation for Chapter 24, Full Disclosure in Financial Reporting. In this presentation, we will review the requirement for full disclosure and how it is implemented throughout the financial statements. We will also discuss the disclosure requirements as they specifically apply to related party transactions, post-balance sheet events, segment information, and the requirements for interim reporting. In the second part of the presentation for this chapter, we will discuss the auditor's report and management's reporting responsibilities. We will also discuss disclosure requirements relating to fraud and what financial forecasts and projections are, and then we will cover the appendix on basic financial statement analysis. In this learning objective, we will review the full disclosure principle and describe how it is implemented. The idea behind full disclosure is to be as transparent as possible in reporting all of the financial facts that might influence the judgment of an informed reader. Full disclosure often has significant cost involved, such as with segment reporting. However, the benefits of segment reporting seem to outweigh the cost, as most users of financial statements cite that segment reporting is some of the most valuable information in the financial statements. Some critics have complained about the amount of disclosure and even said it amounts to information overload. However, when there is a high-profile financial fraud such as those shown in this slide, there is always a call for why the investors were not provided with full disclosure. It's humbling when you look at this slide to think that everything you've worked so hard to learn through your college years in accounting is only a small part of the total information that is available. This highlights that while financial statements provide the backbone of the information for investors and other users about a company, it is only part of the picture that is used to make informed decisions. This slide also illustrates the increase in reporting as the notes and supplementary information required by companies has greatly expanded over time. This slide shows some of the reasons why financial reporting and disclosure requirements have increased so substantially. First, the business environment itself has become much more complex. There are larger companies, many times operating in diverse industries, doing business in many parts of the world with complex transactions that aren't easy to understand without extensive notes. Another necessity is for the information to be provided as timely as possible. Today's news is old news, so the push of the SEC has been toward more forward-looking information that we will discuss later on. Also, since SOX, accounting has taken on much more of a monitoring and control role, so much so that we use the term Enron-itis when discussing the standards and disclosures needed to prevent the type of fraudulent reporting that led to the crisis. Generally accepted accounting principles now require so much disclosure that some have called for differential disclosure for small and large companies called Big GAAP versus Little GAAP. The FASB has traditionally taken the stance that there should only be one set of GAAP, but they do take under advisement input from the Private Company Council to evaluate whether alternatives are needed to address the needs of users of private, non-public company statements. For example, the FASB eliminated the requirements for fair value and segment reporting for private companies. However, this has not been enough for some critics who want to end requirements for reporting deferred taxes, leases, and pensions. I think having studied many of these topics this semester, you can appreciate the complexity that these principles bring to financial reporting and disclosure. Although the financial statements themselves are what we focus so much of our attention on in accounting courses, the notes are really an integral part of the statements. Without the information in the notes, much of the qualitative information that is needed to make informed decisions would be lost. Although sometimes complex and difficult to understand, they do provide meaningful information and users do read them. Accounting standards require that the first note or a separate summary of significant accounting policy section precede the notes and provide information on the significant accounting policies used in the presentation of the financial statements. If you haven't already reviewed in one of your previous accounting courses the summary of significant accounting policies in a 10K, I would encourage you to look up one of your favorite companies and read their statement. This is a review question. Which of the following do you think should be disclosed in a summary of significant accounting policies? Did you get it correct? It would be depreciation methods followed. Although the other information that is shown should be presented elsewhere in the notes, the depreciation method is the only one of these that would be included in the summary of significant accounting policies. Other common notes that we would expect to find in the financial statements of most large companies would include the items that are shown on this page. As you review each of these, try to think about what you have learned in Intermediate 1 and 2 that relates to disclosure for each of these items. In the second learning objective, we will cover disclosure requirements specifically for related party transactions, post-balance sheet events, and segment and interim reporting. Because of problems that can arise with related party transactions, we need additional disclosure of them in the notes. The term related parties refers to individuals or entities who may have dealings with the client in which one party is significantly influenced by the other, such that it may not pursue its separate interest. Examples of related parties include officers, directors, principal owners, and members of their immediate families, as well as affiliated companies such as subsidiaries. Related party transactions require disclosure of the nature of the relationship, a description of the transactions for the periods presented, and the dollar amount of transactions, including amounts due from or to the related parties. It's important to note that disclosure is required even if there's nothing wrong with the transaction and the reporting is accurate. It is the nature of the relationship between the parties that determines the disclosure needs. This is another review question. If a business entity entered into certain related party transactions, it would be required to disclose all of the following except, hopefully you identified that it is the nature of any future transactions planned between the parties and terms involved that is not required to be disclosed. All of the other choices would need to be disclosed, as we said in the previous slide. Because there is a period of time between the end of the financial reporting period and the date that the financial statements are issued, auditors are required to search for information regarding post-balance sheet events, or as they are called, subsequent events. There are two types of subsequent events. Type 1 subsequent events provide additional information about conditions that existed at the balance sheet date. These types of events require recognition in the financial statements through a journal entry. The second type of events, called Type 2 subsequent events, provide evidence about conditions that did not exist at the balance sheet date and require only disclosure if they are material. Many subsequent events or developments do not require adjustment or disclosure. Typically, these are non-accounting events or conditions that management normally would report by other means. Some examples of non-recognized events include legislation, product changes, management changes, unionization, marketing agreements, and the loss of important customers. This exercise will see if you are able to distinguish between Type 1 and Type 2 subsequent events. If you think that the financial statement should be adjusted, then put A. If you think that the event should only be disclosed in the notes, put B. And if you think that neither is appropriate, then put C. I will give you just a minute to take some time to jot down your answers so that we can see if you are correct, and then we will go over them. Hopefully you got these correct. As you can see, the first situation listed should be A, because the settlement of the federal tax case concerned an event that existed at the balance sheet date and therefore would require an adjustment to the financial statements for the additional amount of the settlement. The second item would not require any adjustment or disclosure in the financial statements. The loss of the assembly plant due to fire and the sale of a significant portion of the company's assets should be disclosed in the notes. The retirement of the president would not be reported in the financial statements or notes, but would be reported by management through a press release most likely. The issuance of a significant number of ordinary shares would require disclosure. This is the second list of subsequent events, and again I will pause for just a minute so that you can jot down your answers and then we will go over them. As you can see, most of these, 7, 8, and 10, require no adjustment or disclosure in the notes. While these are important to the users of the financial statements, they would not be required to be reported in them. Number 9 would be a type 1 subsequent event if the customer had been experiencing a decline in their financial condition over time. However, if this bankruptcy were sudden, perhaps due to a natural disaster, then this could be considered to be a type 2 event. Number 11 would be another type 1 subsequent event and would require adjustment of the financial statements. The last item, merger with another company, would require disclosure. As we mentioned earlier in the presentation, many companies are diversified, which means that they are doing business in different industries. General Electric is involved in diverse industries, including locomotives, jet engines, and water purification systems. Investors and other users of the financial statements benefit from having income statement, balance sheet, and cash flow information on the individual segments that compose the total income figure. Companies have been hesitant to disclose segment information for a variety of reasons, but there are also many arguments that support segment reporting. As we have noted, this information is some of the most important to users. Another aspect of the complexity of companies is that many operate not only in different business activities, but also in different economic environments all over the world. Segment information helps the users to better understand the enterprise's performance, as well as to better assess its prospects for future net cash flows. Altogether, the information helps them to make a more informed judgment about the enterprise as a whole. GAAP requires that general purpose financial statements provide selected information on a single basis of segmentation. Companies can meet the segment reporting objective by providing the segment information based on how the company's operations are managed. Therefore, if the company manages its operations by product lines, markets, or customers, this would be the method by which it would identify the segments. An operating segment would be one that earns both revenues and incurs expenses. has its operating results regularly reviewed by the Chief Operating Executive and for which discrete information is available. Thus, a segment that only provides services to other operating divisions would not be an identifiable segment because it would not earn both revenues and expenses. There is a quantitative materiality test that is applied to each of the segments. To qualify as a reportable segment, the segment must meet only one of the criteria shown on this slide. Its revenue must be 10% or more of the combined revenue of all of the company's operating segments. The absolute amount of its profit or loss is 10% or more of the greater in absolute amount of either A, combined operating profit of all operating segments that did not incur a loss, or B, the combined loss of all operating segments that did report a loss. The last test is that the segment's identifiable assets are 10% or more of the combined assets of all operating segments. We will have an example of the use of these three tests to better explain them. After the identifiable segments have been identified, then there are two tests that are applied to the entire group. First, the revenue of the segments that were identified must be at least 75% of the combined sales to unaffiliated customers for the entire company. Last, the FASB has decided that 10 is a reasonable upper limit for the number of segments a company must disclose. To illustrate these three tests for identifying the reportable segments, this slide shows segments A through F and their revenues, operating profits and losses, and identifiable assets. In the first column, we see that segments C, D, and E meet the 10% test for revenue because they have income greater than $215, 10% of the total revenue of $2,150. The profit or loss test is probably the most confusing, so I want to make sure you understand how it is conducted. First, since there was an overall profit for all segments, the loss for segment F of $5 is not included in the total. The remaining segment's profit summed to $90, and 10% of that is $9. The operating profit and loss test is met by segments A, C, D, and E. Now I want to mention though that if segment F had had an absolute value greater than $9, even if it was a loss, it would be included in the segments. The last test is identifiable assets. The total is $970, so 10% would be $97. Segments C, D, and E meet this test. So the identifiable segments are A, C, D, and E because the segments only have to meet one test to be included. The last test is to determine if the identified segment's total sales are at least 75% of the total sales to unaffiliated customers. Adding the sales for the four identified segments A, C, D, and E, we got $2,000, which is greater than $1,612.50, which is 75% of the total revenue for all segments, $2,150. Therefore, the 75% test is met. The information that is required for segment reporting is shown on this slide. The best way to understand the presentation of segment information is to look at an example. Therefore, I would recommend that you look at illustration 24.7, which shows the segment information for Johnson & Johnson. I do want to mention that the FASB does not require allocation of joint, common, or company-wide costs solely for reporting, external reporting purposes. Common costs are those incurred for the benefit of more than one segment and whose interrelated nature prevents a completely objective division of cost among segments. An example of a common cost is the president's salary. allocation of this cost, it would be inherently arbitrary and probably not meaningful. To test your understanding of segment reporting, see if you can answer this question. The correct answer is that the revenue of a segment includes sales to unaffiliated customers and inter-segment sales. Another question for segment reporting. The profession requires disaggregated information in all of the ways shown. Companies are required to report their operations for interim periods that are less than 1 year. The stock exchanges, the SEC, and the accounting profession have an active interest in the presentation of interim information. Interim reporting by public companies on a quarterly basis is a well-established and accepted practice. Analysts and investors want information as timely as possible. There are two viewpoints for reporting interim information: the discrete and the integral approach. The discrete approach would treat each period as a separate accounting period, whereas an integral approach treats each interim report as an integral part of the annual report, and that deferrals and accruals should take into consideration what will happen for the entire year. In general, companies should use the same principles for interim reports and for annual reports. For example, if a company uses the percentage of completion method for recognizing revenue on an annual basis, then it should use the percentage of completion method for interim reports as well. However, there are some allowances made for inventory and period cost. Because of the short-term nature of interim reports, there are some special reporting problems that need to be considered. Advertising and similar costs may be deferred in interim periods if the periods benefited are beyond the current period. Also, expenses such as bad debts expense, executive bonuses, pension cost, and inventory shrinkage can be estimated and allocated to interim periods as best they can. Some income taxes are progressive. It is recommended that companies use an annualized approach by making the best estimate it can of the effective tax rate expected to be applicable for the full fiscal year. For purposes of computing earnings per share and making the required disclosure determinations, each interim period should stand alone. That is, all applicable tests should be made for that period alone. Some companies have very seasonable revenues. An example would be the natural gas industry, which has its heavy sales in the winter months. The problem of seasonality is related to the expense recognition principle in accounting. Seasonality causes wide fluctuations in profits because off-season sales do not absorb all the fixed cost. To remedy this problem, some companies have adopted a way to avoid the fluctuations by making all fixed non-manufacturing costs follow the sales pattern. This follows the integral approach. Also, companies should report 12 months of periods ended at the interim date for the current and preceding years, and they should also disclose the seasonal nature of their business. To review interim reporting, we have another multiple choice question. The answer is, as we discussed previously, the profession feels that interim reporting should be viewed as an integral part of an annual period. This is the end of the first part of the presentation for Chapter 24, Full Disclosure in Financial Reporting.